Ready when you are, mucus head.
Course 101, Section 1 activity, fill in the blank. Do you want me to say a blank is?
No, a property tax.
You want me to just read it? Okay. Well, I was going to go back and give it.
No.
Okay.
Read it.
A property tax is a tax that is measured by the value of property that a person owns. A taxing unit is a local government that levies a property tax. The Comptroller of Public Accounts Property Tax Assistance Division provides technical assistance to taxing units and appraisal districts. The CAD is governed by its Board of Directors.
CAD. Whenever you see that word, it's CAD.
The body of citizens who hears property tax disputes is known as Appraisal Review Board. Section 2. Calculating the taxable value of a property with lump sum exemption. A home has an appraised value of $150,000. The property qualifies for a $25,000 homestead exemption. What?
Nothing.
Calculate the taxable value of this property. Appraised value less applicable exemptions equals taxable value. $150,000 less $25,000 equals $125,000. Taxable value is $125,000. A residential property has an appraised value of $80,000. The property qualifies for a 20% exemption. Calculate the taxable value of this property. Appraised value times exemption percentage equals exemption amount. Appraised value less exemption amount equals taxable value. 80,000 times 20% or 0.20 equals 16,000. 80,000 less 16,000 equals 64,000. So the taxable value is $64,000. Number 3. The appraised value of a residential property is $140,000. The taxing unit, which is a city, offers a general homestead exemption of 15% and a lump sum exemption of $15,000 for 65 or older. This property qualifies for a 65 or older exemption and the general exemption. Calculate the taxable value of this property. Appraised value times exemption percentage equals percentage exemption amount. Percentage exemption plus lump sum exemption equals total exemptions. Appraised value less total exemption equals taxable value. $140,000 times 15% is equal to $21,000. The lump sum $15,000. $21,000 plus $15,000 equals $36,000. Total exemptions equals $36,000. $140,000 less $36,000 equals $104,000. Taxable value is $104,000. Section 3. Approval of appraisal records. The total appraised value for a district is $154 million, and the total property value remaining under protest is $6,800,000. Will the Appraisal Review Board be able to approve the appraisal records? Dun, dun, dun.
I think so.
Yes. If the Appraisal Review Board has substantially completed the hearings, hearings are substantially complete if the amount under protest is no more than 5% of all other property values. $154 million less $6,800,000 equals $147,200,000. $6,800,000 divided by $147,200,000 equals 0.04619 or 4.619%, or $147,200,000 times 5% equals $7,360,000. $6,800,000 is less than $7,360,000. In this particular case, yes, the Appraisal Review Board may approve the appraisal records. And all were happy.
It has to be 95% done or better.
Section 4. Tax rate calculation. A taxing unit needs $3 million for a levy, and the chief appraiser has certified the taxable value to be $550,000. $500 million. What rate would the governing body need to adopt? The levy divided by the value equals the levy divided by the value times 100 equals the rate. So,
in parentheses, read the parentheses.
What? So 3 million divided by 500 million equals a number. Be sure and get that first because it's in parentheses. Then multiply that by 100 to equal 0.0060 times 100 equals 0.60 per 100. What rate would the governing body need to adopt if the chief appraiser certifies 550 million of taxable value and the taxing unit levy remains 3 million? Levy divided by value equals a number times 100 equals a rate. 3 million divided by 550 million equals a number times 100 equals 0.005454 times 100 equals 0.54 per 100. Section 5, Delinquent Tax Calculation. A property owner's original 2017 tax bill of $1,800 is delinquent as of February 1st, 2018. How much penalty would be due on May 15th, 2018? The penalty is 6% in February, 1% in March.
What are you looking at me for?
I'm figuring you're getting ready to correct me.
No, just read it.
Well, I was, but you correct me often.
I didn't say a word.
I was just making sure. Okay, so the penalty is 6% in February, plus 1% in March, plus 1% in April, plus 1% in May, equals a total of 9%. So the penalty is 9%. So you take the delinquency amount of $1,800, multiply by 0.09 equals $162. How much interest would be due on May 15th, 2018? So interest is equal to 1% in February, plus 1% in March, plus 1% in April, plus 1% in May, which would be equal to 4%. So your interest is 4%. So you take the delinquent amount of $1,800 times the 4%, 0.04 equals $72. Section 1, Review Questions. What is a property tax? A tax that is measured according to the value of property a person owns. What is a taxing unit? A taxing unit is a local government that imposes property taxes. What are the 4 types of entities that can be taxing units? The 4 types of entities are cities, counties, school districts, and special district. What is an appraisal district? A special purpose local government that appraises property for property tax purposes. Name 3 state agencies that have responsibilities concerning property taxes: Comptroller of Public Accounts, Texas Education Agency, and Texas Department of Licensing and Regulation. How does the Texas legislature affect the property tax system? By passing laws that govern its operations. What is a governing body? A group of officials that oversee the operations of a local government. What is the name for the governing body of the appraisal district? Board of Directors. Briefly describe the role of each of the following in the property tax system. Chief Appraiser, the chief appraiser of the appraisal district. Assessor, the assessor calculates taxes and prepares tax bills. Collector, the collector collects and accounts for property taxes. The ARB is the body of citizens who hear property tax disputes. Number 10, list the 4 phases of the tax cycle in the correct order. Appraisal, equalization, assessment, collections. Section 2. List the steps in developing appraisal records and give a brief description of each step. Discover property, find taxable property and determine who owns it. Classify property and list its characteristics. Determine the property type and collect all necessary data for appraisal and property description. Appraise the property. Determine the property's value in the manner required. Determine situs. Determine the property's situs where it will be taxable, where it situs. Am I saying it wrong? I'm saying it wrong. Sorry. You got to correct me.
You said situs.
Is it situs or situs?
It's situs.
Okay, so then I didn't goof it up. I'm surprised. So we determined situs. Determine the property situs where it will be taxable. Apply exemptions for which the owner has qualified. Review exemption applications and the facts of each case and decide if the owner qualifies for an exemption. Send appraisal notice to owner. Send the owner a written notice that describes the property, value, exemptions, and jurisdictions in which it is taxable. The notice states an estimate of taxes on the new value. Submit the records to the ARB. Officially transfer responsibility for the development of records to the ARB. Why is situs important? The appraisal district can only list property that is taxable by the jurisdictions in its boundaries. Situs rules allow the appraisal district to determine if a movable item is taxable. What is the purpose of an exemption? Exemptions reduce the tax burden on a property by making all or a portion of the property's value not taxable. Complete the exemption table on the following page. List homestead exemptions that each jurisdiction must offer. Oh, that's ugly.
It really isn't. You're going to be reading the columns.
Yeah, but I'm going to have to zoom out to be able to carry each column down. But okay, so the taxing unit is the school district. The general homestead is $25,000. 65 or older homestead is $10,000. Disability homestead is $10,000. 100% disabled veterans homestead, 100% of appraised value. Surviving spouse of an armed forces member killed in action and surviving spouse of first responder killed in the line of duty, 100% of appraised value. Donated homestead to a disabled veteran, exemption equal to veteran's disability rating. Taxing unit, county, general homestead, $3,000 against farm to market flood control tax. 65 or older homestead, none. Disability homestead, none. 100% disabled veterans homestead, 100% of appraised value, that's on the county. Surviving spouse of an armed forces member killed in action and surviving spouse of a first responder killed in the line of duty, 100% of appraised value. And for the county, the donated homestead to a disabled veteran is exemption equal to veteran's disability rating. For the taxing unit of the city, there's not a general homestead. There's no general homestead exemption. For the city, there's no 65 or older homestead. For the city, there's no disability homestead. For the city, there's a 100% disabled veterans homestead of 100% of the value. The city has 100% of the value for the surviving spouse of the armed force and first responder. And the city has exemption equal to veteran's disability rating for the donated homestead to the disabled veteran. For the special district, there is no general homestead. There's no 65 or older homestead, and there's no disability homestead. For the special district, there's 100% of appraised value for disabled veterans homestead. For the special district, there's 100% appraised value of surviving spouse for armed forces and line of duty. And there's exemption to equal veterans' disability rating for the donated homestead to a disabled veteran for the special district. Complete the following list. Complete the following table listing optional homestead exemptions that each jurisdiction may offer. Taxing unit, the school district has up to 20% of appraised value for the optional general homestead. The optional 65 or older homestead is $3,000 or more for the school district, and the optional disabled homestead is $3,000 or more for the school district. For the taxing unit county, the optional general homestead is up to 20% of appraised value.
And you notice they're all the same.
I do. For
we can just say that school, county, city, and special district all offer the same, or they have the option to offer the same.
Okay.
You can read it that way. I'll be done with it.
You just did. It's great.
Well, probably can't hear myself.
Why not? Okay, he wants me to say that the school district, county, city, and special district all offer the same for optional general homestead, optional 65 or older homestead, or the optional disabled homestead. Right?
Didn't I read the things?
Oh. Okay, all four offer the optional general homestead of up to 20% of appraised value. They all offer $3,000 or more for the optional 65 or older homestead, and they all offer $3,000 or more for the optional disabled homestead. I hope you are satisfied.
Trying to shorten it up a little.
Briefly list examples of exemptions that fall in each of the following categories. A non-business personal property exemption. Household goods, personal effects, family supplies, other non-business personal property except mobile homes, leased vehicles used for personal use. Farm and ranch exemptions are supplies, farm and ranch equipment, implements of husbandry, crops and livestock. For business exemptions, tax abatement for economic development, free port, goods shipped out of state, goods in transit, goods moved to another state, goods moved to another location in Texas, business personal property and mineral interests worth less than $500, pollution control property, stored drilling rigs, property used or transported in interstate commerce, cemeteries, a single business vehicle if it is owned by an individual and used partially for personal use. Group or organization exemptions consist of government-owned property, public property, charitable organizations, religious organizations, youth development organizations, veteran organizations, and community housing development organizations. List the circumstances in which the appraisal district must send the property owner a notice of appraised value. Appraised value of property that has increased, appraised value of property greater than rendered value, property added to appraisal roll for the first time, property reappraised, ownership change, notice requested by the property owner. Calculating taxable value. Taxable value is equal to appraised value less applicable exemptions. If both percentage exemption and a lump sum exemption apply to the property, each exemption amount should be calculated separately. A property has an appraised value of $95,000. It qualifies for a 20% optional homestead exemption, a $25,000 general homestead exemption, and a $10,000 over 65 exemption. Calculate the taxable value of the property. Percentage, 95,000 times 20% equals 19,000. General, 25,000. Over 65, 10,000 for a total of $54,000. For the taxable value of 95,000 less the 54,000 equals 41,000. Calculating taxable value. A home has an appraised value of $120,000. The owner has applied for and received the 65 and older person's homestead exemption. What is the home's taxable value for a school district that offers no optional homestead exemptions? Appraised value, $120,000. For the general exemption, $25,000. Over 65, $10,000. For a total of $35,000. So the $120,000 less the $35,000 equals $85,000. Appraisal cap calculations. If a resident's homestead qualifies and its market value increases by more than 10% over the previous year's appraised value, the appraiser must calculate a capped appraised value. Based on the information listed below, what value will be listed in the appraisal records? Prior year appraised value, $120,000. Current market value, $164,000. Value added by new improvement, $10,000. The formula for the cap is prior year's appraised value plus 10% plus the value added by new improvements since last year. The prior value times 10% is $120,000 times 10% equals $12,000. $120,000 plus $12,000 plus $10,000 equals $142,000. If the cap formula results in a higher number than market value, the property is appraised at market value. The value listed in the appraisal record should be $142,000. Section 3. Name the important individuals and boards involved in the equalization phase of the property tax process. The Chief Appraiser submits records for review. The ARB hears and determines protests and challenges. The taxing unit file challenges and receive appraisal rolls. Property tax owners file protests. What are the responsibilities of the ARB? Hear and decide the property owner protests, written complaints about appraisals or other matters. Hear and decide taxing unit challenges, written complaints about certain matters. Correct errors in previous year appraisal rolls, and approve appraisal records each year. Who may file a protest to appear before the ARB? Property owners file their protests. What are the potential grounds for a taxpayer protest? Excessive appraisal, unequal appraisal, situs, denial of exemptions, denial of special use appraisal, determination of a change of use on previously qualified agricultural or timber land, determination of ownership, failure of the ARB or Chief Appraiser to send required notices, any other action that adversely affects the owner. Who may file a challenge to appear before the ARB? Taxing units file challenges. What are the grounds for a taxing unit challenge? Level of appraisal of a property, category, or geographic area. Exclusions of property from the records. Grant any type of exemption. Determination of special use appraisal. Failure to identify the taxing unit as one in which a particular property is taxable. The total appraised value for a district is $58,500,000, and the total property value remaining under protest is $1,850,000. Will the Appraisal Review Board be able to approve the appraisal records? Dun, dun, dun. Yes! If the Appraisal Review Board has substantially completed the hearings. Hearings are substantially complete if the amount under protest is no more than 5% of other values. $58,500,000 less $1,850,000 equals $56,560,000. $1,850,000 divided by $56,650,000 equals 0.03265 or 3.27% rounded. Or $56,650,000 times 5% equals $2,832,500. So $1,850,000 is less than $2,832,500. In this particular case, yes, the Appraisal Review Board may approve the appraisal records. And there was much rejoicing in the land. What is the deadline for concluding ARB hearings? July 20th if the ARB has substantially completed the hearings. Number 9, true or false, why? The ARB must complete all pending protests and challenges before July 20th. That is false. The ARB must complete substantially all protest hearings before approving the appraisal records. They may only do so if the value of the property remaining under protest is 5% or less of the value of other properties in the district. True or false, and why? The ARB must certify appraisal rolls to each taxing unit by July 20th. False, and they don't tell us why.
This is July 25th. That's why.
Okay. Section 4. What are the two major activities in the assessment process? Taxing unit sets the tax rate. Individual taxes are calculated and billed by the assessor. Number 2, what are the 5 key concepts in assessment? Taxing unit must adopt a new tax rate each year. Taxing unit must follow a detailed set of steps in specific order to ensure that the rate is valid. Setting the tax rate determines how much property tax revenue will be generated and the amount of each taxpayer's bill. The governing body sets the tax rate to generate the amount of revenue by governing body feels. The governing body sets the tax rate to generate the amount of revenue the governing body feels is needed. The appraisal district and ARB have no role in setting the tax rate. The assessor cannot calculate individual taxes or prepare tax bills until the tax rate has been set. Who sets property tax rates? The taxing unit's governing body. How do you calculate a tax rate? Divide tax levy by total taxable value and multiply by 100. If total taxable value is $45 million and the tax levy is $1,462,500, what is the tax rate? $1,462,500 divided by $45 million equals 0.0325 times 100, which is equal to $3.25 per $100. What kind of public expenditures comprise M&O? General expenses such as fire and police protection, salaries, building maintenance, etc. What kind of public expenditures comprise debt? Payments on long-term bonds and other types of long-term debt. A taxpayer owns property valued at $175,200, which qualifies for a 20% homestead exemption, and the local city tax rate is $2.33 per $100 of value. What is the owner's tax liability? $175,200 times 20% is $35,040. $175,200 less $35,040 equals $140,160 of taxable value. $140,160 times 2.33 equals $326,572.80, or $326,572.80 times 100 equals divided by 100 equals $3,265.73 rounded. How will a successful rollback election affect a taxing unit? A taxing unit's rate will be reduced to the rollback rate. If the taxing unit has begun collecting taxes, it must refund the difference and the delinquency date is extended. Tax rate calculation. A taxing unit desires to levy $1,500,000. The taxable value is $300 million. What rate does the taxing unit need to adopt? Desired levy, $1,500,000. Tax rate equals desired levy divided by total tax value times 100. So $1,500,000 divided by $300 million times 100 equals 0.500000 0.500000 per $100 of value. It is common to carry a rate to 5 decimal places and cut off without rounding. Tax levy calculation. A taxing unit has a total taxable value of $250 million. How much levy will a tax rate of 0.45025 per $100 generate? The levy is equal to total taxable value times rate divided by 100. So 250 million times 0.45025 divided by 100 equals $1,125,625. The taxable value of Miss Smith's property is $82,000. The tax rate is 0.35790 per $100. Calculate the amount of tax Miss Smith owes. Tax amount equals value times rate divided by 100. 82,000 times 0.35790 divided by 100 equals $293.48. Section 5. What are the two types of tax office, standalone or consolidated? Who is responsible for collecting property taxes? The collector. What are the main functions of the collector? Receive payments, issue receipts, deposit funds, post transactions to accounts, post payments to tax records, balance accounts, send notices to taxpayers, issue refunds, issue tax certificates, and reports to governing body. When are taxes due? Taxes are due when the bill is received. When will taxes become delinquent? They are delinquent if not paid prior to the delinquency date, usually February 1st. What types of refunds are automatic? If a refund is not automatic, what must the taxpayer do to obtain the refund? Automatic refunds include appraisal roll corrections, corrections to the tax roll, approved late homestead exemptions, rollback election reductions, court-ordered appraisal roll changes, and duplicate payments. If a refund is not automatic, the taxpayer must file an application for the refund with the collector within 3 years of the date of the refund becomes due. Auditor and governing body approval may be required. What is a tax certificate? A signed certificate showing the amount of delinquent taxes, penalties, interest, and costs and expenses associated with a previous tax foreclosure sale due on a property as of the date the certificate is issued. What are the elements of an effective delinquent tax collection system? Mailing bills and notices on time, keeping good address records, taxing legal actions to secure payment when other efforts fail. Describe the rate at which penalty and interest accrues on delinquent tax. Penalty, 6% on the first day of delinquency, 1% for each month thereafter, capped at 12% as of July 1st. Interest, 1% on the first day of delinquency, 1% for each month thereafter. Additional penalty for collections attorney, up to 20% of the total tax penalty and interest due as of the date it is collected. What is a tax lien and how is it enforced? A tax lien is a legal interest that gives the taxing unit the right to have the property sold if the tax is not paid. The tax lien is enforced by foreclosing the lien and selling the property. A tax warrant is typically used to seize what type of property? Any personal property owned by the person who owes delinquent taxes. True or false, and why? The cheapest way to pay property taxes is to wait until after a tax sale and redeem the property from the buyer. That is false because the added penalties and costs associated with the suit and the redemption amount make it much more expensive to redeem the property after foreclosure. What does a tax deferral affidavit do? Who can file it, and to what properties does it apply? It bars the taxing unit from taking action to collect a tax. A 65 or older or disabled person or or disabled veteran may file for a tax deferral. It applies only to the person's residence homestead. You may have to prorate taxes when some types of exemptions end during the year. The idea is that if the exemption was in effect for, say, 2/3 of the year, the owner should only be liable for 1/3 of the total taxes. You must know the date the exemption ended and be able to calculate the total number of days between the date of the exemption ended and the end of the year. Then divide the number of days by 365 and multiply the number by the total taxes that would be due. So it's expressed as a formula as prorated tax is equal to tax without exemption times days left divided by 365. An exemption ends on December 31st. There are 30 days until the end of the year. A total tax for the year would be $1,520 if there were no exemptions in place, and calculate the prorated amount of tax. The prorated amount of tax is equal to number of taxable days divided by 365 times total annual tax. 30 divided by 365 is equal to 0.821917. So 0.0821917 times 1,520 equals $124.93. I don't know if I can finish this, although we are very close. I'll finish it. I can push through.
Yes, I think 6 more pages or something like that.
Although I scrolled too far now, I don't know where I'm supposed to be.
127.
At the top.
Mm-hmm.
Huh?
Mm-hmm.
Okay, delinquent tax calculations. Interest is equal to 1% times the number of months that the tax has been delinquent. Part of the month is counted as a full month. For example, if the tax becomes delinquent February 1st and the tax is paid April 1st, the interest is 1% times 3 months, or 3%. Calculate the amount of interest if a tax of $1,400 becomes delinquent on February 1st and is paid on June 1st. So the original tax amount is $1,400. Interest rate is 1%. Number of full months delinquent is 5. Interest is equal to original tax amount times the number of months times the interest rate. Stop. So the interest is $1,400 times 5 times 1% is equal to $70. Penalty on a delinquent tax is not as simple to calculate as interest. The first month's penalty is always 6%. The penalty then accrues at 1% for each succeeding month through June. If the tax is still delinquent on July 1st, the penalty is set at 12% and remains there until the tax is paid. Calculate the amount of penalty of tax of $2,500 that becomes delinquent on February 1st and is paid on April 1st. So original tax amount is $2,500. Number of full months delinquent is equal to 3. The penalty of 6% for February, 1% for March, 1% for April is equal to 8%. The penalty amount is $2,500 times 8%, which is equal to $200. A taxing unit that contracts with a private law firm to collect delinquent taxes may impose an additional penalty of up to 20%. The percentage is applied to the total tax, penalty, and interest due at the time the tax is paid. The penalty usually takes effect July 1st. An original tax bill of $2,820 becomes delinquent February 1st. The taxing unit imposes an additional penalty of 20% of total tax, penalty, and interest due. Calculate the total amount due, including the additional penalty, if the property owner pays on July 1st. Original tax amount, $2,820. Number of months delinquent, 6. Interest calculation, 2,820 times 6 times 1% equals $169.20. Penalty calculation, the tax was still due on July 1st, so the penalty is 12%. $2,820 times 12% equals $338.40. Total penalty and interest, $338.40 plus $169.20 equals $507.60. So tax plus penalty and interest is equal to $2,820 plus $507.60 equals $3,327.60. Additional penalty calculation is $3,327.60 times 20% is equal to $665.52. The total, including additional penalty, is $3,327.60 plus the $665.52 equals $3,993.12 for the total amount due of $3,993.12. Done.
Yeah, go down. We can read those definitions.
No, not tonight. I cannot. I'm sorry. I'm throwing in the towel. I'm tapping out. Uncle,